Good morning, ladies and gentlemen. Sorry we're a bit late. I'm normally cognizant of time, and I do know that there's somebody else releasing results later on today, so people are on a short-term constraints. Just maybe before we go through the presentation, I'm sure some of you have squeezed through in terms of what we're going to be presenting through today. I think it goes without saying that, probably the last 6 months has been a very, very tough 6 months for us, an extremely tough period. I think a few things have not come to fruition that we anticipated to come through, particularly around the long-awaited signing of government leases, which we've been talking about for quite some time. I actually did a study for my board. We've actually been talking about these long-term leases since 2014, which is not great. It's absolutely not great, and it's something that we obviously place a lot of emphasis on. A lot of the underpin or the value in Delta, or the value that we perceive to be trapped in Delta, obviously will emanate from the releasing of those leases. So I think, given the seriousness that we take it, and obviously we'll be discussing it on one-on-ones, we have invited some representative from DPW. They will make a short presentation in terms of where the status quo is. We will give our side of the story, but we felt it is important for shareholders, particularly, to hear from the horse's mouth, so to speak, in terms of what is the latest status. The good news is that I have heard as late as Friday that a couple of leases have started trickling out, including one of our buildings in Umtata, which is Broadcast House, which I think is, it's a small step, but it's a very, very significant step, because clearly we've been talking about the policy, and we've waited for the leases to start rolling out. The one other lease that the one or two other leases that we've heard about are for one of the landlords on the unlisted space, which also, I can confirm that, as of even this morning, we had a chat with him. He has confirmed that he has received those leases. So leases are starting to come out, but I don't want to dwell too much onto that, because obviously I'm hopeful that our partners from Public Works will be here during Otis's presentation to obviously dovetail, and obviously they can give their side of the story. Just in terms of the market, it has been quite a rough market. I think since the last time we were on the podium, we are on our third finance minister, which which is not great. Sorry, Shanil. I think Shanil thought he has been fired here, but I think there was no one more shocked than Shanil. But from a sovereign perspective, people go to sovereign historically as a safe haven. In South Africa, we find in the converse. It's actually quite disappointing for us that, particularly during the climate where I've historically been on record to say that it's during these tough times that, investors should be looking for a safe haven in the sovereign underpin space, because obviously sovereign always pay their rental. They don't move around very much, within the CBD. And I think the lag in signing of leases is obviously impacting what we see as our opportunity to shine in the market. And hopefully, we can perhaps deal with that today with our colleagues from DPW. So I think from an overall perspective, as I've already said, we are on our third finance minister. The midterm budget speech was not great, but it was a very factual look at the state of the state. And, I think there's a lot of questions that obviously emanate from that. Already we're starting to see the theme of the size of the cabinet. What does that mean for Delta? Going into an election year, we certainly don't think that there will be mass staff retrenchments, even though there probably may be fewer ministers going forward. But even that, we don't see a high likelihood of that at this particular stage. I think that's just maybe to give a high-level view without going into too much detail. My two colleagues will obviously touch on that. Obviously, we are under significant pressure with our banking partners to get these leases signed. Our cost of capital, because we've been renewing or refinancing some of our debt on a short-term basis to make sure that as and when those long-term our WALE improves, we can then synchronize our debt expiry profile to our WALE. Obviously has seen a slight uptick in terms of the cost of debt. But Chanil will take you through that, and he's still employed, I can assure you. All right. You would have seen that from the results that we announced today that our revenue has ticked up slightly from sovereign, from 75.9%, and that's as a result of some of the disposal that we did during since the last half year, particularly in the Joburg CBD. We sold some properties, we sold some Damland assets as well. So that has ticked up our exposure to about 79% of our revenue coming from sovereign. So I think, during the close off, I'll let you know what is our gut feel going forward. Is sovereign still a viable option? And we'll touch on all of that. What is also important is our BEE credentials, and I think it's something that we place a huge amount of level on. One of the sneak preview that we have had is that one of the bid committees has basically come down quite hard. Historically, you would have recalled that Otis would have presented that we were pushing for 9-11 month leases. Obviously, since we haven't been able to conclude our BEE deal, we know that there is pushback to renew Delta at about a 5-year lease, which obviously has an impact. We historically, based on the high-level discussions we had discussed with them, they were initially prepared to accept a BEE plan whereby we then implement within 12 months. It seems like they've taken a more hardline stance with regards to the leases that are at stage 3, and Otis will touch on that again, that they are talking more 5 years rather than the 9/11, with the view of us basically convincing them on the BEE plan. So I think just like shareholders are saying, well, show us the leases, they are also saying, show us the BEE credentials, don't tell us what you're going to do. Rather perform, then you get credited for what you've done. Pretoria and the Durban CBD are still dominant nodes. I think for us, those are strategic nodes, particularly Pretoria, because most government departmental headquarters are obviously based in Pretoria. There's quite a lot of space that is, required by their headquarters. And, as of today, in fact, even the city of Tshwane went out to tender. And the tender actually closes today. That's why some of our colleagues are not here, because they are basically submitting quite a large tender. The city of Tshwane has gone out to tender for 105,000 square meters of GLA that closes today, and we've obviously put in quite a few assets there to try and obviously attain. Where we see value is some of the big tenants that they've got are about 45,000 square meters. There's a 56,000 square meter tenant in the number of tenants that they've got. Parking is becoming a major issue, and I think Pretoria will definitely be something that we are watching. And for those of you that have seen our vacancy schedule, obviously we are managing that we can get a fair slug of that tender process from the city of Tshwane, which closes today, I've already mentioned, to help us manage some of those vacancies. Also, which has gone up is the value, is the 109 million rands value per property, which historically we've always mentioned, which is, we like big chunky assets, because again, it's quite difficult for user departments, we can't stress that enough, within the CBDs to find. It is our logic that the smaller the tenants, the more nimble they can be. The bigger the assets, the more difficult it is to move within the inner CBD. Obviously, we don't want a scenario where the tenants feel trapped. We want a scenario where they would like to be there. And I think obviously our CapEx program that we have long since announced is something that we do need to get off the ground eventually. I've touched on the bulk lease negotiations. Those continue. Otis will give a lot more granularity around that. If members, shareholders, and bankers and banking partners remember, DPW did go on the podium whereby they committed to signing all the expired leases by 31st December. We are holding them to that. We have even, as I've already mentioned, invited them to come and share the podium with us, which is unprecedented, I think, to try and instill some sort of confidence, because we obviously understand there's shareholder fatigue in terms of management coming through and saying long-term leases are coming, and it's better that you actually hear from themselves. Of our leases, if you recall, there are 3 stages to the negotiation process. 41% of those 227,000 square meters of GLA that is currently under negotiations are at the last stage, which is stage 3. And we are hoping that in the next a few weeks, we will start getting some of the Delta leases rolling out of that stage, just like we've obviously picked up. One of those buildings has already been announced as of last week Friday, and we are definitely aware of one other landlord on the unlisted side that has obviously received his leases as well. The increase in vacancies is obviously, we are still taking a lot of pain in the Free State. It's that portfolio needs a combination of capex. We do need to spend some defensive capex there, and also I think the state of the buildings is such that it is making it quite difficult for us. It's been quite a problem area for us historically. I think we've already mentioned that. The other node where we continue to battle is Sunning Hill. Ordinarily, Sunning Hill is not a node that we would have bought into were it not for Eskom. Obviously, with Eskom going through its own challenges, we've obviously they've taken a slightly less space, and we've been looking and scratching our heads in terms of how to deal with that particular sets of properties that we have on 3 Simba Street, 5 Simba Street, and the likes. And obviously the conversions at this stage don't work for us, whereby we could look at doing some sort of conversions and maybe attracting a different type of tenant. In the interim, our exposure, as I've already mentioned, our revenue has gone up slightly from Sovereign as a result of us disposing of some of the properties. Of concern, and it's a pity our chairman is not here, is that our debtor days have gone up from 18.1 to 31.6 days, which is not great. It is definitely something that is extremely concerning to us, that our debtor days have gone up, almost doubled to 31.6 days. That is as a result of driven primarily as a result of 2 issues. One is we had a tenant move out, which is the Department of Stats, and the other is Department of Transport, which is at our Forum building. You would have seen from our results presentation that we talk about a provision of 30 million, where it's not really a dispute. I think there's discussions between what the actual GLA of the building is vis-a-vis what our leasing clients, being Department of Public Works, have gone through. They've gone through a measurement. Their measurements are slightly different to ours. Obviously, we are of the view that we have a recourse from the people that we bought the building from, and it's something that we will definitely be picking up. The board has taken a very, very prudent approach to say, let us provide fully for the amount of 30 million during this period, rather than wait for the conclusion of those discussions with DPW. On the debt side, I think, as I've already mentioned, we are using temporary facilities at this stage. I think they are not only us, but obviously our banking partners. We are all waiting for these long-term leases to start rolling off the system, which is obviously something pretty critical. We have managed to refinance 1.3 billion rands worth of facilities on a temporary basis. Obviously, that has seen our cost of debt tick up slightly from 9.2% to about 9.3%, but I'm sure Chanel will touch on that later on during his presentation. As I've already mentioned, the entire property sector, I think, not only in the listed environment, but also unlisted environment, it's been extremely challenging, and more so in the office environment. As such, we have seen quite a slow pickup in terms of the pace that we are able to dispose of some of our disposal list. It goes hand in hand. If the buildings don't have leases, banks are not prepared to fund new players to basically buy those new properties. So, I think, I know some of the cynics will say we are placing too much reliance on government signing leases to kickstart the whole process. But the truth of the matter is, actually, that is what is needed. Is if the leases can start rolling off, we are of the strong opinion that the sovereign underpin space will definitely start working and work as a catalyst, not only from a financing perspective, but if you look at just Delta's got a 600 million rand capex that we have spoken about, which obviously will trickle down and about job creation and the inner city development. It could really act as a catalyst in terms of the inner city rejuvenation. And I know that some of our competitors have got similar capex programs that are on hold pending long-term government leases. One of the things that I did mention when we were on the podium last was that particularly it started in eThekwini, where the eThekwini municipality had condemned its building. We obviously were the beneficiaries at that stage, where the eThekwini departments moved into embassy. We moved some of those tenants at Delta Towers. We've unfortunately, what has happened is that the fire at the Lisbon building in Johannesburg has obviously put a huge spotlight on health and safety issues, particularly around these government buildings. And as we historically have always mentioned, it is only fair that our government employees are in health and safety qualifying buildings. That they do pay rentals, but we do obviously need to make sure that they also understand that for landlords to spend huge amounts of investment, that is basically the catalyst of that is basically them signing leases as well. We had an unfortunate incident at one of our buildings, which is in Pretoria, around Pointings. That one was quite an interesting incident because, we had started a fire upgrade project, which is costing us about 32 million, whereby we were more than 60% or close to 70% of the project. Our professional team was in constant contact with the fire marshal from the city of Tshwane. So we found it quite strange that they decided to pick on Pointings to go and do an audit during the upgrade to say, well, but we've already told you that the building is not compliant. We are busy spending capex to basically upgrade the building. So for us, it seemed rather strange that that's the one building that they did choose. Thankfully, I think sanity has prevailed, and we obviously thank our colleagues from DPW, the user department as well, from correctional services. It was a joint effort. I think it went very, very well. The building is open, I can assure you. Some of the issues were obviously not landlord obligations. Some of the obligations were tenant specific around fire escape, doors and access and so forth. So, I think without sensationalizing it, it's something that I think, again, proves that if we could work jointly with our clients, I think things that can get resolved pretty speedily. That building was opened after a week with, obviously minimum disruption with our client department at that particular stage. As such, our board has been quite specific. We obviously have done quite a detailed health and safety audit in terms of the rest of our buildings to know which other buildings are not compliant. And obviously we have plugged that onto our CapEx budget as well, so that those are in sync as well. On the recapitalization, I've touched on the BE or the recapitalization program. This is something that we've spent a lot of time on. We've obviously pulled the cautionary at the moment. As I've already mentioned, it doesn't help that whilst we are obviously speaking to funders, we are speaking to potential funders about sovereign. Obviously, the whale is something that is of huge concern to potential funders. The other issue is obviously we've had, as I've already mentioned, is when you keep having a change of leadership at Treasury, at Finance, that obviously doesn't instill a lot of confidence from a funder perspective. So that is obviously playing to some sort of delay. And added to that is that the midterm budget speech didn't instill a lot of confidence in terms of the state or the health of the state. So I think a lot of particularly the one funder that is actively looking and engaging with us on this is taking a wait-and-see approach, particularly as there are a number of cabinet posts that are open, whether there will be major announcements around the size of the cabinet, what if that will have a major impact in terms of how government continues to lease, or will they be taking smaller spaces as such. So I think that is something that obviously we will be engaging with shareholders on. What we are clear about is that it can't be business as usual. For us, it is important that our user departments or our client departments do come to the party. We have seen our banking partners come through to the party, and dare I say, we'll also be looking to our shareholders to come to the party as well, with regards to finding a lasting solution. We have been through quite a protracted period where I think the market is expecting something to happen, and I think we do need to find a joint solution to that. We have got a couple of ideas that we would like to discuss with the market, and it is absolutely imperative that we start seeing some results for that. I've already mentioned that we've got an extensive capital requirements going forward. That what some of the fund managers are missing out is that even with the long-term leases, part of the commitment with those long-term leases comes huge capex requirements. We've mentioned Schedule C. That is a new requirement as part of the process, and somebody has to fund that, and we can't keep going to the banking partners solely to fund that. And we have a number in mind, and we need to find out where that line will be. If it's a 5-year lease, obviously the quantum is not as great. If it's a 9-11 month lease, the quantum is slightly longer. But certainly we can see that that is going to be the capex issue is going to be. It can either be a negative for us, or I think we are looking at it as potentially a competitive advantage if we are able to move with speed and secure our funding and plug in that capex. It will give us a competitive advantage, not only because of the size of our buildings, but also the grade and quality of our assets as well. Obviously, I think I've touched on the reduction of funding costs and so forth, because we are obviously using interim funding structures at this stage. But I'm sure Chanel will pick up on that. I'll be back at the end to deal with the closure and just a summation and where we see the environment going forward. let me hand over to Shanil. Oh, sorry. I think what we have announced today, before I hand over to Shanil, is obviously the distribution that has been impacted quite markedly by the 30 million rand provision that we believe is quite a prudent mark. We have a guidance to market of 2 to 6% for the full year. We still believe that is still intact. But for the period, we are 15% down year on year. If you look at the 39.4 cents, where would we have liked to have been? And that is obviously impacted hugely by the capex spend that we have obviously spent now, and that 30 million rand provision. Of huge concern that we are spending a lot of time on, and we've even got our chairman involved to try and assist us, is the creep up of our debtor days. This is something that we historically, in our 6 years since listing, that number has always been below 18 days. So the fact that it's creeping up is obviously of serious concern for us. But we have mentioned that it's two big tenants have pushed up that number there. Once we resolve the stats matter, and we are sure that we can resolve the forum discussion, that will obviously have a benefit and bring that down. The rest of the tenants, I can assure you, are definitely paying. They're on time. On some levels, we even do get prepayments as well, which we have seen, has always been the case for the last 6 years since listing. Also, the uptick in our vacancies, I've already mentioned, as a result of the Free State portfolio, is something that we are spending a lot of time on, and we do have some vacancies even in Pretoria, as I've already mentioned, that there's 105,000 square meters of GLA that closes for tender today with the city of Tshwane, which we are busy with. I think, Shanil, let me hand over to you. I'll be back at the end just to conclude. And in the interim, we will have Otis Shabalala, and I'd like to welcome Daya and his colleagues, and I'm sure they'll hopefully shed some light into the burning question around the leases as well. Thank you.
Thank you, Sandile. Warm welcome to all present here this morning and on the webcast, our esteemed guests from DPW, led by Mr. Governor. I'm actually happy to have you as witnesses this morning as well. Sandile has confirmed I still have a job. I'm not moving on. So yes. Financially, so I think, the slides you have in front of you, some of you may have seen the SENS announcement that has gone out, so I'm not going to dwell too long. I think Sandile has covered some of the critical elements from a financial perspective in the business. So I think just to give you some of the performance within the business, and maybe just to elaborate, if you look at our LTV ratio, it's gone up slightly from year end to 43%. One of the reasons for that is that we have taken out a new facility during this period from Investec. We've also benefited from our investment in Grit, and I think maybe just to spend a short bit of time on Grit. Historically, we've equity accounted Grit. Grit has been an associate of the business because we did exercise significant influence, obviously with Sandile being the chairman on the board and with the quantum of shareholding that we had in excess of 20%. Subsequent to Sandile leaving the board of Grit and Bronwyn vice versa, and with the recent capital raise, our shareholding is just under 8%. So Grit is no longer accounted for as an associate. It's now carried as an investment in our books, and on that basis, we just do the fair value at each reporting date. So in essence, that's given us some benefit, obviously with the Grit's successful listing on the LSE and the share price gaining some momentum, and that's benefited us slightly. But the LTV obviously remains quite a critical measure in our lives, in our business, and we're hoping, together with the department, once the long-term leases are in place, we obviously have got quite a few initiatives to ensure that we manage this number. As I've said, our long-term strategy is to have this number closer down to the 40% mark, if not below. And I think we will achieve that. With regards to the facilities, it's never ideal to say it's on temporary refinance, but I think it's better than saying that debt has been called up. So I think we must thank our banking partners. I see the Nedbank team, Standard Bank team, Investec as well, that they obviously understand the government space. They know that the leases are imminent, they're coming, so they've partnered with us, and we're obviously rolling this on a month-to-month basis at this stage, and to have a firmer term once the leases are in place, and that will also assist us with some of our other major ratios in the business, our covenants, our debt expiry profile, to term that out. Fixed debt, as I've mentioned historically, 80%, that's our sweet spot. We obviously want to maintain that over 80%. We do have 3 interest rate swaps that are expiring in February. So obviously, taking into account the economic climate and all of the sentiment around interest rates and where they will be heading, we are obviously engaging at this stage to try and ensure that we do secure, maintain our fixes over 80%, but still getting the value that will be beneficial to the business. Debtors days, 31.6%, and speaking to the audience here and our stakeholders, shareholders, cash is a big thing in our lives, considering that we are expected to distribute that to our shareholders every 6 months. So having the debtors days move up obviously was not ideal. And I think, as Sandile has mentioned, it's about 2 or 3 big clients that are responsible for this. So this is not really a reflection that there's chaos in the payment system from our partners. It's not the case. It's obviously these 2 or 3 tenants where there is engagement that's taking place. So it's fruitful at this stage. And I think, as Sandile has highlighted as well, we did go, we had our pre-close about 2 months ago. We spoke to the market. We said, listen, we're giving you a guidance. We're revising our reversion from 2 to 4 to 2 to 6%. We were still spot on to meet the 2 to 6%. And I guess there was some communication that happened during the course of last week. And the board and ourselves as management felt it prudent for us to just err on the side of caution and put through that 30 million rand provision. So without that 30 million rand provision, we would have achieved our 2 to 6% reversion. Property operating margin, 68%. You will see that's another notable increase in our business. A big part of that as well is the provision, because the provision obviously relating to the tenants are classified under operating expenses. So if you had to exclude that 30%, and let's look at it more on a normalized type basis, our operating margin has still increased slightly. So our historical gross cost to income ratio has been range bound between 26.5 to 28.5%. I've also been on record previously to state that 28% is more the sweet spot for us. This financial year end, we were sitting at around just under 30%. So again, that speaks to the level of maintenance and repairs. We've obviously accelerated that program, and that's coming, and that's obviously based on what's happening in the market as well. So being responsible landlords, we have obviously ensured that we are trying to invest as much as possible into our portfolio. Interest cover ratio, and I'm glad even with the 30 million provision, we don't breach any covenants. Our interest covenant with the banks are at a minimum of 2, so we're still fairly comfortable in this space. Financial review, so I think this is just getting a bit into the nuts and bolts of what you guys would have seen on SENS and what's in your booklet. Revenue, it's crept up marginally, and I think, as Sandile has highlighted that as well, the disposals that have taken place obviously have eroded some of that revenue base, that increase. There's a like-for-like net property income slide that we will be looking at. And, if you just look at it from a revenue perspective, like-for-like, excluding all of the, let's call it the one-offs that have taken place in the business, it does reflect a 0.8% increase. If you then factor the vacancy factor that increased from August 17 to this reporting period, we were then at just under 3%. So vacancies, and we're going to touch on that as well. Otis will give you a bit more color around the vacancies, but what has really hurt us is the Bloemfontein portfolio. 2 specific buildings where tenants have moved out that have now become vacant, and that obviously has really eroded our revenue base. The net property income as well, the 30 million again, sorry, you're going to be hearing this 30 million over and over again, but it's had a role to play there, obviously coming through property operating expenses. From a finance cost perspective, the increase that we see in front of us, there's obviously quite a few components that are responsible for this. So, if you just look at our legal debtors that we have in the business, which we have communicated to the market as well. This year we've taken the view and we are raising interest, but again, to err on the side of caution, we're raising it and we're also providing for it. However, on the finance cost line, there's almost about 4 odd million rand that relates to the interest that we're raising on the area legal debtors that we have, and that's non-DPW. That's more the retail debtors, issues that we've had over the last 2 years, which we have communicated to the market as well. In addition to that, we've taken out a new facility with Investec. That was the 180 odd million rand. So that's added a further 3 odd million rand to this base. And then obviously, together with some of the temporary refinance initially, we've had a bit of fees that we've incurred. So if you just look at those 3 components, they account for just under 10 million rand of this increase. So we are still fairly comfortable that, at this stage we have a handle on the debt from a cost perspective, and that's thankfully to our banking partners as well. And we're just hoping, that's one of our strategies to manage going forward as well. I've mentioned the cost to income. There again, if you take out the 30 million provision, the net is sitting at about 13.4%. So even our net has increased marginally from historic, where we've been between the 11 to 12.5%. A big part, if you look at the normalized of 13.4%, the vacancy factor, that has had a role to play within our net cost to income ratio. There's certain overheads that we're not recovering, common costs. But we also, within our asset management team, there's certain recoveries that we need that the guys are busy with, and we want to try and ensure that we actually increase the margin of recovery on the portfolio. I've spoken about the cost to income. Again, normalized without the 30 million, it's just about the 30-odd% mark. Investment property, the increase that you see, there's obviously ongoing capex in the business. And like Sandile has pointed out, one of the major projects being Pointons, just under 33 million rand earmarked, and we've spent a fair amount, just about 20 million rand to date. The project's expected to be completed by Jan. So in essence, the next couple of months, there's going to be quite a bit of commitment with regards to payment. On the balance of the portfolio, we've been speaking about Commission House. Minister Pravin Gordhan has now moved into that building. We've spent about 14 or 15 odd million rand on that building. So that capex together between Pointons and Commission House, they're largely responsible for the movement in our assets, our property assets. Investment in listed securities, that's grit. Again, you will see the benefit with regards to the business listing on the LSE, gaining some traction and demand. So that's actually helped us increase the investment value, which obviously is a measure within our LTV ratio. Borrowings, again, increase. I've been talking about the Investec facility of 180 million rand. That's one of the major components of the movement in our borrowing costs. A lot of the other issues we've covered already. Yeah, I think the weighted average interest rate, like I said, 9.2 to 9.3. We're hoping that once the leases are concluded, it'll give us a bit more leverage, and we'll be able to have much more robust discussions around rates. Debt expiry, we're down to 1.1, and this is as a measure of passage of time. Obviously, we haven't done anything significant, and these are other covenants and matrix in the business, that once the leases are in place, we're hoping to have that termed out quite significantly. Net asset value, sitting at 9.93 rand. There again, if you look at some of the fair value adjustments that obviously filter through to net asset value, we do have a dollar-denominated loan with the Bank of China. And obviously with the movement in rates, there has been unrealized forex loss of about 30 odd million rand. So that obviously trickles through into your NAV calc. All right. So just on the distributable income statement, this is just a reconciliation that will help you calculate from our NPI to the final amount that we're distributing of 281, the factors that we take in between. And another item to emphasize, obviously, is if you look at the straight line, you know, the fact that it's a negative to the statement of profit and loss tells you that a lot of our leases are at the tail end, are at the end. And that's purely a measure of straight lining. So there again, you know, once we put our lease terms in place, we are obviously hoping to have this reflecting in the opposite direction. Admin expenses, and it's just a repetition of what's coming out of the income statement. Just to look at the number of shares in issue, that's the closing number of shares we have in issue. You will notice the weighted average is slightly lower, and that's purely a factor of the dividend reinvestment program that we had at year end. We did issue shares, and that's the discrepancy that you see in between. The shares that we issued are only participating for 3 months, and that's the reconciliation. This is just a graph that depicts the trend of our distributions, and as you can see, I mean, this is where, you know, our leasing, from a leasing perspective again, all of that needs to translate into the numbers. And I guess with the leases being signed and coming to fruition, there is going to be benefit in the numbers that we see, you know, especially from a funding cost perspective, revenue perspective, depending which way the final negotiations head. But that's quite a critical measure in our lives to ensure that we get the business stable, and this trajectory is again an upward trajectory. The distributable earnings bridge, this is just a bridge that shows you August 17 to August 18. You know, we're coming from the highs of 330 down to 280, and this is obviously the sign that has been eroding some value for us. You know, if you look there again, you will see the disposals factor is quite significant on our portfolio itself, and that's a factor again of the provision. And then obviously you will see the vacancies, like I've mentioned. You know, the 14 million rand base that's eroded from the portfolio you had at August 17 to August 18 is a big cause of concern for us, and our team is working hard and fast on that. Like for like, 4.4%. Here again, I think, like I mentioned earlier on, if you take out the effect of the provisions and the vacancies, you know, we have had growth of just under 3%. So we obviously have to look a bit deeper into this number than just the cold face that sits out here. And here again, you know, the like-for-like increase, once we get the, you know, our vacancy factors are right, we've got more stability in terms of the lease agreements and the lease arrangements. I mean, we would obviously like to ensure that our like-for-like is sitting within the range of about 3.5% to 5.5% at least, depending how we settle. So that's more of a target. And the financial statement of financial position, I've been through that. As you can see, the current assets, a big component of this, about 410 odd million rand, is the trade and other receivables, which was sitting at about 340 odd million rand financial year end. That increase correlates to the debtors days, moving from the lows of 18 to the highs of the 36 that we've got on the board. Okay, investment in grid. There's anything to highlight on the slide, and we can pick it up further in our one-on-one discussions. Net asset value bridge. Here again is just showing you the period at financial year end. We thought this is more prudent than going back to August 17, because this is the number we've seen, down to the 993, and you would see, you know, again, the dividend is always the major part, because that comes, that's quite a huge number within the reporting period. But generally the contribution from operations is where you should be seeing a lot larger contribution. And again, this has been hampered by the 30 million rand provision in our books. Debt summary, like I said, the only thing different from financial year end that we've highlighted or spoke about is the Investec facility that we've got. The balance, we're managing it on a month-to-month basis. Some of the facilities we've extended up to the end of March, but again, it's not ideal in our view. I mean, it is still temporary, and we obviously want to get a lot more certainty around that. This is just a graphical representation, and you can have a look at this in your booklets. The debt expiry profile. There again, you will see, based on the chart we presented at financial year end, there hasn't been a significant change. Obviously, with the shorter refinance that's taking place, it's still staying within the Feb 19 block. We obviously would have hoped to have had this right down and termed out. But again, this is a factor of once the leases come into play. This is just some information to the graph, and you can have a look at that with regards to the facilities. There's about 1.9 billion. You would see the 730 that we've done, which is part of the 1.366. Some of the standard banks we've done up to the end of March. That's the quantum that sits in there, and you can peruse this in the slides as well. So I think I've covered this, and again, we can't emphasize enough. The intention is to term out our debt expiry profile together with the fixes that we have, and these are all a factor of the leases coming to fruition. So with that, I hand over to Otis, and he'll take us through the operational side of the business. Thanks.
Okay. Good morning. Welcome to everybody. Special warm welcome to Mr. Daya Govender and his team, Eric Ramsey from the Property Finance, and Maurice Mapinja, the Chief Negotiator and the leasing team. What we've done this time around, we decided to do things differently. At our pre-close in August, we had a conversation with most of our shareholders, and the overriding theme that came out of the pre-close was an update on the leasing performance. We also had a pre-market sounding feedback when we were doing our results, and the key things that came up again was the elephant in the room. And we thought it prudent that we invite our partners from GPW to come and share with us as a team and the investment community where we are in terms of the leasing, and to touch a bit on the health and safety, because those are the two main issues that most of the shareholders wanted to know where we are on that. We are seeing most of you on one-on-ones. We'll deal with the rest of the operational matters there, where we'll touch on vacancies and the disposals. But I want to use this opportunity to touch just on the operational highlights before I invite Mr. Governor to come and take us through. DPW and Sovereign remains our biggest client. Just under 80% of our income comes from government. There is 4 different levels of government. National Department, which is where Mr. Governor and his team come from, makes up about 40% of our income. Provincial makes up just under 20%, and we've got the local municipalities making up 12, and the state-owned enterprises making up the remaining 8. So we do place a lot of reliance on Sovereign. It's been a tough, challenging market. We've had some minimal successes in terms of renewals. We've managed to renew about 52,000 square meters. Most notable on those renewals is we've got Auditor General in Polokwane, where we've got a 5-year lease agreement. We also have Eskom in Sunning Hill, who've signed up on a 1-year lease, but we've gone on tender, and we're potentially getting a 3-year renewal on Eskom in Sunning Hill. We also have a bit of success, not quite the numbers we're looking for in terms of new leases that have been concluded. We've done 9,600 square meters. The one that we are really chuffed about is the Mr. Price in Durban. It is a small one, but we got a 10-year lease agreement for a call center in Durban. And I know the property management team is working closely with Mr. Price to potentially get another 5,000 square meters in the building taken up on a 10-year lease. The vacancies have gone up. We're sitting at 13.3, but if one looks at our core portfolio, it's not as high as it is. It's 11.8%. That is driven mostly by 2 areas. The Free State in Bloemfontein. We have about 80,000 square meters in Bloemfontein, of which half is national and the other half is provincial. The national component, we are bullish. When the bulk renewals come in, we'll get that renewed. With the provincial, we continue lobbying and working with the provincial government to try and get those leases renewed. But we have lost 2 tenants in the Free State, and we continue bleeding in the Free State. In Sunning Hill, as I mentioned earlier, we had 20,000 square meters, which was predominantly taken up by Eskom, number 1 Simba, 3 Simba, and 15 Simba. In number 5 Simba, which is Eskom, we will be getting the 3-year lease. We're quite advanced. And then in number 15 Simba, we managed to get a non-government and non-sovereign tenant, the medical aid company called Universal. They've taken up 2,000 square meters with promise of an additional 8,000 that we are looking to get there. In terms of the elephant in the room, we have submitted the 227,000 square meters at national. It's quite a sizable chunk of our national portfolio. It's made up of 59 lease agreements, but it's predominantly made up of just under 6 departments. There's various stages. I know some of our competitors have gone public when they've done stage 1 and reported to the investment community and the funders that they've concluded leases. There is a 3-phase approach to the negotiating. I think stage 1 is where we meet with the negotiating team that is made up of DPW and Treasury. That department is staffed with property professionals. We've got valuers. We sit and debate the rentals and the grading of the building and that kind of thing. Then after that, when you've reached agreement, so we can safely say on all 59 we've concluded on stage 1. It then goes to stage 2, where the negotiating team takes it up with the user departments. There, my understanding is that they go and confirm budget and their requirements in terms of space and what they would like to see being done on the buildings. We have it on good authority that 3 to 5 departments have confirmed their budgets, and without trying to take from Mr. Governor's presentation, we are quite well advanced in that. So, touch wood, we envisage that the bulk renewal at the last conference that Mr. Governor and Morris and the team had on the 31st of May, where some of the investment community was invited. There was a deadline of 31 December that was set up, and we'd just like to get an update. So on the remaining operational issues, we'll delve more into that on our one-on-ones. But with that, I'd like to officially hand over to Mr. Daya Govender, who is, his official title is Divisional Head for the Property Management Trading Entity. Thank you.
Good morning to the Chairman of the Board, members of the Board, shareholders, the Chief Executive Officer, the Chief Financial Officer, and the Chief Operations Officer. It is indeed a privilege and honor for me to address you today. As government, we are fairly proud when organizations who we have supported as part of our empowerment program succeed. And it is an honor for us to share this occasion with you. This invitation to address the Delta Property Fund today is indeed an important one. As I indicated, it is also a time for us to share in some of the successes as we transform the property industry. There were significant rumors from March that I will be taking over the real estate management portfolio. I did play an advisory role and asked the Minister to engage with the property industry on the 31st of March. On the 11th of June, I was asked to come and address the significant delay in stabilizing our real estate portfolio. In particular, the delay in the lease renewal was almost 18 months by the time I assumed this responsibility on the 11th of June. I met CEO Nomvete on the 4th of July. I gave him half a day of my daughter's holiday just to understand the pressures that the fund was experiencing with the delays and try to work out a plan that would One, bring some conclusion to this matter that has not been finalized. I thought then I would make significant changes by the 30th of September. Unfortunately, it's government and the bureaucracy, so I was able to do that by the middle of October. I have now instituted a new team of the negotiators. I've got Mr. Morris Mabinja, whom I've worked with extensively on the lease renewal process in 2013, 14, and 15. So I wanted his experience to drive this process. Secondly, to deal with the issues of payments to landlords. We are government. We are not here to withhold payment and earn interest. Our job is to pay for the services delivered on the date that we specify, and not even quibble about a 30-day payment. 30 days only applies when we have some queries with each other. Okay, and that is not significant when you look at the portfolio you have. Okay. Now, my challenge that I was explaining both to the CEO and on Thursday last with the Chief Operations Officer, Otis Shabalala. He made me work till midnight that night. Okay, is that the top 25 landlords I intend to complete before the 31st of December this year. And you rank number one in that group because you are the largest landlord that we lease property from. It's small compared to the portfolio I manage. I have 75,000 tenants in my building, but I lease about 2,500 at the moment. In fact, it's 2,556. I have a backlog of further leasing for 500. So there will be 500 tenders, Otis, you need to prepare for. Right? I'm confident that if we work properly together, that we will be able to clear up the payment issues. Tomorrow, we've set a meeting, Shanil, so that we can finalize the reconciliations and expedite those payments. That's why I have appointed Eric Ramsamy to now act as my property finance person so that we clear those issues as well. I met both the CEO and the Chief Operations Officer in the 2013-14 period. Otis used to follow me around the country as part of that lease renewal process. We've readdressed all the landlords, which was driven by Morris, since we've assumed responsibility in June, and that has been accomplished. What we now have to do is make sure that we, working with Eric and his team, we clean up what we owe each other, if that is, so that we start on a clean slate. Hopefully, tomorrow's meeting, Shanil, will be able to do that reconciliation. What I can announce, the involvement of the SIU, and it was initiated by myself and the minister in particular, was to review 2,163 leases which I had renewed in the 2013-14 period, and to look at if there were any elements of fraud and corruption. I can safely announce that for the Delta Property Fund, there is no issue of fraud and corruption. And so we are doing business professionally and ethically with each other. The issues that have been raised, and I think they've been enumerated by the CEO and I was walking, is a matter of reconciling what the GLA is specifically. Because the Auditor General in any given audit can select any building for audit. And when they do, they physically measure the building, the space occupied, and test it against the agreements concluded. Okay? And so the AG and the SIU in particular had to do that for all 2,163. And so those are the issues that we now will clear up with the landlords before we renew. The Chief Operations Officer has indicated the 3 phases. In your case, you passed phase 1. We are at phase 2. I'm also losing patience in some of the client departments. They no longer have to give me a funding confirmation because we are reducing rentals. What they do have to give me is a funding confirmation if I've increased the rental to a market-related. But more importantly, they need to give me a confirmation of the term. In your case, it's 5 years. Unfortunately, there is a BEE policy in place, which we have inherited, that was signed in February, and the process to review that is another 18 to 24 months. So we don't have time to review that. That will be applied, and therefore there was a debate about whether the blacklisted funds could qualify for a 911. And I'm hoping that that clarity is given in the next 3 to 6 months with our engagements with the Property Sector Charter Council, who at our instance facilitated the previous engagements. I am then hoping that the partnership that we have with Delta is one that is open and honest, and that it is able to grow as a company by providing us quality buildings at the best possible price. Given that I got 500 new leases and tenders to put out and renew 2,556, there's a significant stability we'll bring to the market. Firstly, in terms of your 59 leases, is it 57? 59. Your 59 leases, at least we would have conclusion in some major way by 31st December. If there's any ones we could not conclude, then my target will be February. My total target to close this lease renewal process is the 31st of March. I was anticipating 2019 first quarter only to deal with a residue of the leasing. I can confirm client departments have been giving us written confirmations, and as that comes through, I've appointed a new chairperson of the bid adjudication committee who independently will make a decision on the acceptability of the work done by the negotiating team. So I do have a new team in place, and the reason I put a new team is that they cannot meet once a week. Their job is to meet, whether it's 5 days a week, to clear that which we will be bringing to them. Currently, we have concluded over 200 negotiations for leases to be renewed, and that has to be processed on an almost full-time basis. So I hope that the shareholders are indeed satisfied. We can't apologize more for the delay, but we can work together to ensure that our first target of 31st December is met, and any residue for the big companies, it's February. For the smaller landlord, it's the 31st of March. And with that, we'd like to wish you well. Thank you.
Thanks, Dave. Thanks very much. I know you will share my message to Mr. Governor and his delegation that obviously what we are doing today is obviously unprecedented. It's quite an important step, and I know that maybe some of our other colleagues, Mr. Governor, please make your time available. I'm sure they will also invite you to come through, because we don't want to be given special treatment, as you've already mentioned. We know that we spend a lot of time making sure that we do follow through. We are quite pedantic. I think the investment market, unfortunately, does invest in confidence. There's a lot of cynics amongst the investment community. It's don't tell me, show me. So I think definitely on that day, government and Delta, I think, will definitely be celebrating that day when we can see some of the bulk leases being renewed. And I think the big question, the big anomaly that has not been mentioned here, is the cost saving, which you just alluded to. That is quite a significant incentive for government. And I think I can attest from your negotiating team that the pace and the cost savings, particularly with the Treasury team, the cost of the savings in terms of the revisions that you are looking for, they are pretty significant. Obviously, from a finance perspective, we've obviously plugged in those numbers that we have negotiated into our forecast going forward, and it's something that, our future guidelines are already in place. I think we felt it was quite important, as unprecedented as your presentation was, that actually the market gets to re-hear from you in terms of what the steps going forward, and we thank you. We do know that you've got a meeting with the Minister shortly, and so please, we won't take it badly if you do have to scurry away. Thank you very much for seeing us at just short notice. It's not often that one gets to hear directly from the tenant, but we just felt, given the criticalness in terms of what this potentially means for a company like Delta, to have DPW come out and speak, I think was quite important. Obviously, it's got a huge financial incentive from our side in terms of once we get those long-term leases, as you've heard from Mr. Governor, it obviously translates into something that we can obviously start spending on CapEx. Obviously, health and safety is a major issue. Sorry. Okay. I think we've touched, just to conclude, we've touched on the bulk leases. We've obviously spoken very much at length about that. The investment on capital in terms of renewal and retention. Schedule C is quite specific in terms of they've been very, very specific in terms of what building needs what, and we need to commit upfront with detailed studies that have been requested in terms of whether it's fire, whether it's other health and safety commitments, which we basically have committed. And as you've heard for yourself, they've basically accepted some of those proposals, and we obviously are moving through the 3 stages going forward. On the refi perspective, as these leases come out, I think have got almost a direct line to our banking partners to basically almost on a portfolio by portfolio basis to obviously go on a roadshow to the banking partners and make sure that we then synchronize our debt expiry profile in conjunction with our new fund WALE. I think if we are able to achieve across the board 5-year leases, we can still start seeing our debt expiry profile obviously tick up, and that will obviously be beneficial. What that means is obviously our CapEx regime can start going forward. I've mentioned on the next point here on terms of the vacancies on the Tshwane, on the 105,000 square meters, and we've got a nice surprise here that there's 500 other tenders coming out from DPW, even within their existing pool that we were not aware of, which obviously, again, will augur as well for a fund like Delta. We are obviously of the view that, we have the assets. We do obviously some pockets and some strategic vacancies around the country that we will obviously try and position our fund accordingly. Clearly, I think the whole property sector, listed property sector, particularly in the office space, has been through a tough period, and we do anticipate that to continue until we actually come to a close in terms of the full leasing profile. Fortunately, we've seen some traction from local government in terms of particularly eThekwini municipality and City of Tshwane, I think, could become a very, very big tenant of ours, particularly if we are able to get quite a big chunk of that 105,000 square meters, which is all Pretoria based, which is something that I think we have obviously have got our eye on. The guidance, I think we're quite confident. Obviously, chatting to people like City of Tshwane, chatting to DPW, that the guidance that we have given to the market of 2 to 6%, we can catch up in the second half of the year. We have been on record that the bulk of our escalations generally happen on the second half of the financial year. And we obviously have other initiatives that we are not able to share just yet, that we will obviously get as close as possible to that 6%, which I think is looking pretty positive. Given obviously our very frank and transparent relationship with government, we have remained. I mean, we had a strategic session which about a month ago with our board. We are still of the view that there is still quite a lot of value trapped in the sovereign underpin space. We looked at what it would mean for Delta to obviously change its strategy, and we felt it is not worth our while to actually change our strategy, given that we have actually taken the pain over the last 3 to 4 years. And I think it is only just that we basically have got pole position as and when the bulk leases have already started to come through the process. We have obviously heard, more importantly, from our key tenant that deadline of 31st December is still very much intact. And I think between now and then we will be working around the clock, as you've heard, sometimes at midnight, to try and make sure that we get these leases. We don't like to come here and share that we obviously have not closed some of those leases. And I look forward to at the next presentation that perhaps maybe if not, we have not achieved all 59 leases, that certainly a big chunk of the 227,000 square meters has been achieved. With that, I would like to thank you for your time and patience. I know that the program today was a bit upside down, but we felt it was important again to reiterate the message from Mr. Governor and his team, and we do obviously place a lot of reliance on what they tell us, and we have taken a lot of flack from the market in terms of historically the challenges that he has had with his team internally. Thank you very much. We are open for questions, both those from the webcast and that are here. I do know that most fund managers like to carry those questions on a one-on-one. We can then proceed, and myself and my team are still available outside. I'm not sure if there's any questions, Monet, from the webcast. There's not. Okay, with that, thank you very much, and we'll see you outside for further questions.